Good morning and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending January 20th, 2023. Appreciate you all tuning in to this channel as well as our podcast InvestTalk and subscribing. Now, this week I'm going to title the video Debt Ceiling Battle Boosts Markets as Tech Layoffs Mount. And that's the headlines. The headlines are about the debt ceiling and continuation of tech layoffs. I think Microsoft laid off another 10,000 this week. So, I've said this for a little while. It's a continuation of a reversion to the mean. That's what our economy is going through. We were overstimulated in 2020, 2021, and 2022 was the start of that reversion to the mean. And this year is a continuation of the reversion to the mean. But a lot of that reversion is now behind us, and now it's okay. Where is that settling in at a normal rate? Is the economy going into recession? Probably a mild one by year end. When exactly that hits, is up to interpretation. But we shall see. The tech layoffs are a product of that mean reversion. So it's not something that is dire. It's just the tech industry overhired and they extrapolated an amount of growth that happened in 20 and 2021 out much further than was reality. And so they're having to right size their businesses and that's expected. And then when it comes to the debt ceiling, we've gone through this many a times. What's interesting here is that the debt ceiling actually is positive for markets, and it sounds weird, but basically when the Fed or when the government, the Treasury issues debt, they're pulling liquidity out of the system, okay? Because other people, other institutions, the system has to take dollars to go buy this debt, and that's money that assets being sold or things that aren't happening to go and fund this deficit, the capital that's coming out of the system. And so when the Treasury cannot issue more debt, suddenly they're not taking money out of the system in that manner. And what they're doing is they're actually putting money in the system via what is called the Treasury General Account. So when the Treasury issues debt, the dollars that they get for that debt goes into the Treasury General Account, which is basically their checkbook. And so there's kind of a push and pull between debt issuance and spending from the government and money coming out of that Treasury General Account. But right now, there's only a push out of Treasury General Account to pay for the things that we've already passed, and that is putting dollars into the system. And that's a good reason why so far this year you've had a relatively positive market. And so I kind of expect the market to be modestly positive between now and whenever the debt ceiling is figured out. And to me, that would be a sell the news type of event. That doesn't mean sell the news and the market's going to go down 30% from there or anything like that. But, a choppy period is what we continue to expect for most of this year. Okay, so that's what we're looking at. Now, to take a look at the markets right now, you see down here in the middle bottom, you have the Vanguard total stock market. This is total equities, right? We had a nice positive start. We had our first major couple red days, Wednesday and Thursday, in the markets for the year, and we had a little bounce back on Friday. Overall, net a bit positive on the week. Now, the yield curve remains inverted, but more out to the 1 year. What I'm watching is when does it invert on like the 6 month? Okay, so what this is saying is the Fed's going to raise rates, and then they're going to cut rates basically within the next year, somewhere between 6 months and a year. So would not shock me, but that also mean likely that there's some sort of economic or market event that precipitates that. And the bond market always kind of front runs that and always listen to that. So kind of near term, until that 6 months gets inverted, I don't get too bearish on the market overall. Okay, you see remain 1 month returns in the markets. Cyclicals remain very strong. Communication now after really a great week this week, up 12.5% over the last month, and those defensive sectors remain relatively weak. So overall, what's saying is, hey, the market maybe got ahead of itself in pricing in a recession, and now that the market's kind of correcting that, saying, hey, yeah, economy's slowing, but maybe not a recession near term. So I'm watching this for relative weakness as well. The growth side of the market is getting a bit of a rally over the last month. You see that here. Still small cap value and core are the best areas of the market so far over the last month. But you can see large cap and mid cap growth getting a pretty nice boost compared to their value brethren. So, this is, and I'll look into the charts in a minute, but basically this is telling you that, hey, things are shifting a bit. And I'll start off with this. This is ARK to the SPY. So what you're seeing is, right, ARK was just getting crushed, continues to, not do great. But so far this year, it's actually having, compared to the S&P, a much better start to the year. And you get into, some of the ratios. You can just go like the Qs to the SPY. That's starting to get a bit of a rally here. You see Russell 1000 growth to Russell 1000 value. That's this. And growth is starting to get a tick up so far over the last couple of weeks. And a lot of that probably has to do with this, right? The 10-year coming down into major support. And we're likely to remain trade, range bound, on the 10-year for a little while. And with the yield curve inverted, it's basically saying this is headed lower as opposed to higher. And obviously, a Fed that is dovish at some point later this year would precipitate some sort of a rally within the tech sector, the beaten up sectors of the market, the growth side. So, while longer term, I still expect value to outperform, you're starting to get a little bit of signs that you might get a counter trend rally in the growth side of the market. And that all kind of makes sense, right? A more dovish Fed would be beneficial for liquidity. And that would be good for the growth side of the market, at least near term. Now, taking a look at some other indicators, the VIX, that remains down in a downtrend. It's not getting any traction to the upside. And until it does, you can't be too bearish on the market. Now, what you can say is look at the MACD, right? You're getting a MACD divergence. The VIX is lower, but MACD is starting to trend higher. That's something to take note of. The NYSE, this is broken above its 618 retrace for a couple days this week. And this was pretty good resistance. And you're starting to make a little bit higher highs here, higher lows. And I think this could attack this level, which would be that first major breakdown. I don't know if you remember, April timeframe was the first major breakdown. If you go back here, this was relatively range bound, right? You had that first lower low, a lower high, and then the market kind of broke, right? And it broke right here. So kind of the scene of the crime. This would be major resistance here on the about 16,400 on the NYSE. So that's kind of what I'm expecting, is it probably to get there. And then that's maybe when you see some bigger volatility, but that's still TBD. Now, if you look at other volatility indices, the NASDAQ volatility, that remains in a downtrend. Once again, kind of reiterating the point that, hey, the growth side of the market might get a counter trend rally. And so you don't want to get too bearish on the market as a whole, especially because the market's still weighted towards the growth side. Now, SHY, here's short-term rates. Those continue to march lower. Remember, this SHY, so if this goes higher, it means lower short-term bond yields. And then if you look at things like the junk bond, let's go junk to the IEF. It started to break down Wednesday and Thursday, a nice bounce back today, or excuse me, on Friday. And, this remains range bound. So I'm not seeing, this is something I'm watching, right? It's trying to roll over, but until it does, the market should hold up, decently. The dollar, that remains weak. Another kind of near-term positive sign for the markets as a whole. And this is a pretty powerful downtrend. When I see the 50-day start to really get spread away from the 100-day, that tells me that the downtrend is relatively powerful. This isn't a choppy pullback. This is a strong, consistent bleed downward in the dollar. Now, how much of that is pricing in a more dovish Fed? How much of that is the Saudi Arabia talking about taking other currencies for oil? That's certainly part of it. Remember, everything's factorial in the market, and you have to take that into consideration. Now, gold with the weak dollar has been doing very, very well, and lower rates. That's certainly something gold tends to like. And if you look at the GDX to the GLD, that's starting to get some more traction to the upside over the last couple of trading days. And the only thing that is a bit more, I guess I'd say worrisome, is silver has pulled back a bit. Still remains in an uptrend. Silver to gold ratio has pulled back a bit. Silver's still strong, kind of consolidating, but you definitely don't want to see that silver to gold ratio reverse in a big way. And it hasn't yet. Just a pullback so far. Energy stocks getting some nice traction to the upside, remains in an uptrend. The one thing that really, I don't say concerned me a bit, was the XLI to the SPY. So industrials had been outperforming. You see that big surge over the past month. We talked about that at the top of this episode. But this is a pullback, and now maybe that's just the strength in gold, in the growth side of the market that's doing that. But you can see here's XLI. Rough week for XLI overall. Some big earnings reports that were disappointing. I think it was it 3M? Yeah, 3M had some disappointing earnings, and some other industrials not doing quite as hot as the market was hoping. The transportation index, that also that had a choppy week, but remains in a relative uptrend. So that's an overall positive. On Monday, you had the investment banks come out with earnings, and here's another indicator that you might be worried, more near term. So right now there's still a mixed bag. I think the weighted evidence is still near term positive, but you're starting to get that that rollover here in industrial space, in the investment banking. Right, I've talked about this. This is surged. Investment banking should be doing better, and with this rolling over, if this broke the 100-day, I would be worried. It's right at the 50-day. Maybe this is just a modest pullback into support. We shall see. But definitely something I'm watching, because remember, if investment banks are struggling, that means the capital markets in general are going to struggle, because they are very reliant on the capital markets, a bullish or relatively steady asset market profile. So I'm definitely watching this. The XLY to the XLP, we know that consumer discretionary has been outperforming, and it continues to do so. So that's showing the consumer is still relatively strong overall. And I think that's about it. Oh, materials. I want to talk about materials. Materials have done very well, and I think this is an area that's going to catch up. Because if you just do commodities in general, right? You go XLE to the IYM, the materials to the XLE. The materials have been underperforming the energy space. But now, over the past, call it 2 months now, 2.5 months, materials are starting to enter an uptrend in relation to the energy space. So, you have things like copper. There's JJC, that one breaking out to the upside. And there's just a lot of... what's the base metal ETF? I'm trying to remember. XME, that's what it is. XME. Yeah, materials and mining, that's getting some strength as well. So overall, you have to say the weighted evidence is to the upside in the near term. However, you still should expect a choppy market for most of the year. You see these crosswinds, the market's still trying to figure out, the Fed's still trying to figure out. The odds right now are a 25 basis point hike in February 1st. That's coming up in the week after this upcoming week. And then you'll get 6 weeks off, and then end of March, so end of the first quarter, you get another Fed meeting. But you're going to get a lot of economic data from now until then. And I think there's an increasing chance that this one in February is the last rate hike. A quarter basis point, it's like 97% priced in, or odds that it'll be a quarter basis point. But the February or the March meeting, that one's still a little more up in the air because economic data continues to come in more mixed. Okay. And actually, I just realized that I didn't go over all the economic data. I gave you this dashboard, but I didn't go into that. So let's do it in reverse this week before I close it out. You had the NYC Business Leader Survey. That was negative for the fourth month in a row. So clearly in the New York area, that is a tough time in that part of the nation. Industrial production month over month down 0.72%. That was the worst month we've seen in a long time, really since, September of 2021. So the industrial production sector is certainly decelerating. The PPI number month over month down 0.5%, Producers Price Index. So inflation continues to show that it is decelerating quickly. Month over month core was only up 0.13%, the lowest level in really since late 2020. Core producer price index year over year down to 5.5%. So that continues to decelerate. Business activity, that's down 21.4. We've seen that. Actually, I think that was a double dip. Retail sales down 1%. Second month in a row where retail sales decelerated or actually shrank. Building permits, the lowest level since the pandemic and below where we were kind of pre-pandemic, right? We were at 1.45 million. This is a leading indicator of what the home builders are going to do going forward. And obviously that is an important part of the economy. Existing home sales down 4%, down to 4 million. That is now pretty much at the depths of the COVID lows. And then you look at inventory. Inventory is not picking up too dramatically. Still only up 10% year over year, down 13% month over month. That's expected this time of year. Not a lot of people list their homes. But with sales down so much, you would think inventory would be robust. Not the case, right? We talked about people locked in their 3% mortgages, and that's why this is going to be a slow slog of prices coming down. Okay, so that's an overview of the economic conditions. Certainly weak, certainly decelerating, not recessionary. But that doesn't mean we can't get there, and doesn't mean the Fed won't pivot. In fact, the bond market is expecting that by year end. So I think that's it. I appreciate you all for tuning in. I want to remind you the contents of this video are for educational purposes only. It should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a great weekend.